Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Mathew. As we sometimes do, today I'd like to talk to the head of equities at a very large mutual fund to give you a sense of how they manage money, how they're looking at their strategy right now, and what the outlook for the current financial year and in fact the next financial year is, so that you can plan your investments and you set your expectations. Joining me today is Dinsesh Balachandran, who is the head of equities at SBI Mutual Fund. Dinsesh, thanks so much as always for taking the time. And let me ask you, just to set the context, and so that those that are unfamiliar with the strategy and philosophy that you employ when you build your equity portfolios, what is it? And then we'll delve a little deeper as to how that fits into the current dynamic.
Great. First of all, thank you for having me over. Now, with regards to how we think about equities, like what philosophy we operate, we normally think about it from the perspective of three pillars. What are these three pillars? One is the business model, in terms of trying to figure out how robust is the company's business model, what kind of growth runway can we foresee, and inherently, like what are the return ratios for that particular company. That's one pillar. The second pillar is the management competency or ability, because clearly we see differences in terms of how various companies are run. Good management can obviously make a huge difference. So that's the second pillar that we think of. And then the third pillar is essentially the valuation, like how much do you pay for a particular company? So normally what we want in an ideal world is something where you have a great company in terms of having a robust business model run by very competent management and available at moderate valuations. Now, the problem is that real life is obviously much more messy. So while you want the holy trinity, so to speak, in real life, you have to sort of compromise on one dimension or the other. And that is essentially where the art element of investing comes in. And that is what we try to do all the time, essentially.
100%. Okay, so you've given me some perspective on that philosophy. I do want to ask about what has occurred in 2025 so far. And Dinsesh, you said the absolute truth, which is that reality can often confound even the best plans. So from that perspective, it's been particularly volatile. Were you perhaps a little surprised at the kind of rebound that we've seen since March, April, particularly in the broader markets?
I definitely have to agree with that. Like when we were thinking about equities, particularly over the last year or so, there were two big concerns that we had. The first concern was that we saw this slowing down of growth rate. Now, when you look at the last 4-5 years, post-COVID, equity market did well, but it was also on the back of growth rates that were looking quite good, particularly when you think of COVID as the base. Compared to that, growth rate in FY22, FY23, FY24, both at a macro aggregate perspective or individual company perspective, the growth rates were looking quite good. But starting from the beginning of calendar year 2024, it felt like growth rates were essentially moderating, slowing down significantly in certain cases. This was accompanied by valuations being much higher than historical average. So just as valuations essentially went up significantly, we started sort of witnessing moderation in growth. So that was essentially giving us sort of a lot of cause for concern. And from that perspective, we were sort of worried about near-term equity returns. And so when markets went down from September to end of February, to be honest, it felt like this was sort of a sorely needed correction just to bring valuations back in check. Now, when you think about what has happened post the end of February, early March, the rebound has been ferocious. It's almost if you look at all the mainstream indices, they are back to the historical highs or very close to the historical highs. So definitely it has sort of surprised us. But when I try to sort of understand why it has happened and what has been the biggest factor driving this, apart from other aspects, one big change that has happened in the last 6 to 9 months is the reduction in interest rates. So when you think about the relationship between equity valuations and fixed income interest rates, there is a clear linkage, right? Because when the cost of capital comes down, all else being equal, equity valuations get supported even more. So equity valuations can go up. So for us, this has been the one big driver, if I have to think about it, in terms of what has sort of led to a very significant rebound in markets.
Um, so the tendency, Dinesh, and it's an unfortunate tendency that when you look in the rear view mirror as an investor, the tendency is to focus on the very recent past. And so from that perspective, the reason I wanted to ask you about the performance of equity markets over the last couple of months is because of how SBI Mutual Fund's portfolios have done. And I'm just trying to understand at this stage, when you look into the future, and I'm not talking about the next few months, are you looking at a shift? And you mentioned monetary policy. We had another massive rate cut, 50 basis points. I think a lot of people were unaware or caught unawares of that. Do you anticipate that the way that you've positioned, there could be a catch-up in the next 6 to 12 months? And how should your investors anticipate this?
Yeah, normally, like the way we structure our portfolios, we do not react too much to near-term events. Let's assume even if an event were to happen that we weren't really anticipating, normally we do not make wholesale changes to the portfolio because these portfolios are constructed with a certain medium-term objective in mind. So to that extent, nothing much is going to change. Now, at the margin, this fall in interest rates, is that positive for certain financial institutions, particularly the ones that are dependent on wholesale borrowing? Definitely. At the margin, is it beneficial for interest rate sensitive sectors like real estate? Definitely. To that extent, there is clearly a marginal positive emerging in certain sectors. But are we really going to make big changes to our portfolio? That is, in general, not the way we operate. So I do not foresee any big changes in our portfolio in general.
Okay. So then tell me about how, and I specifically want to get your opinion on the construction of your portfolio and your contra fund, which you manage, of course, and how are you positioning yourself there? Because I think there's a lot of interest and people hold this as part of the portfolio and long-term portfolios, and some direction on what you're anticipating and how you're building your portfolio there might give them some clarity.
Yeah. So what I'll say is this. As I was mentioning at the beginning of the discussion, sometime last year, we were getting really worried about valuations across the board. There weren't great opportunities in any sector per se. A lot of the value-oriented sectors that we were focusing on, even those sectors had gotten re-rated so much that we couldn't see any great opportunities in the market. So what we did was essentially preserve dry powder. So where the cash percentage in the fund went up substantially. And this was not really a top-down call, but more this feeling that there aren't enough attractive opportunities in the market. So to that extent, we wanted to err on the side of preserving dry powder rather than be forced into sort of investing in something. So this is something that we did in Contra Fund last year. Now, over the course of the last 9 months, as and when opportunities have opened up in certain sectors or certain themes, we've tried to sort of deploy in those areas. Definitely, like in March of this year, was the situation much better than, let's say, August or September of last year? Definitely. Because a lot of stocks actually fell quite a bit. And to that extent, opportunities did open up. But unfortunately, it was like a fleeting moment kind of thing where it quickly rebounded after that. So to that extent, we couldn't fully deploy. So we still have meaningful cash in the portfolio, patiently waiting for opportunities. Now, when I think about the landscape, there are essentially more opportunities in the market today than middle of last year. Even though when you look at it from a mainstream headline index perspective, it feels like we're back to the same old level. So nothing really has changed, right? But underneath the covers, I think because of the movements in various sectors and so on, definitely more opportunities have emerged. And so we are trying to take advantage of those opportunities in contra fund. So the cash holding has definitely come down. Has it gone to zero? No. So we are still waiting for good opportunities to open up. But I do get the sense that there are more opportunities available today than essentially last year.
Okay. One reflection of that is also in your balanced advantage fund, which at last count, and obviously we're at the start of a new month, so I don't have the latest fact sheet. I'm just wondering, it was about 68, 69% balanced advantage equity. That would have been higher, I'm assuming, than in previous months, and that's probably because equity markets have also moved in a certain way. So it'll be, rather than fresh deployment, I would think that it's also because of capital appreciation. Please correct me if I'm wrong. And also, where does that move going forward? Are you adequately represented in equity in your balanced advantage?
Yeah. So balanced advantage uses the asset allocation framework that we like to think of whenever we have to think about markets in aggregate terms. So last year, in the middle of last year, our model framework recommended an equity allocation of 20%, which is sort of the lowest in multiple years. That was the extent of caution flagged by the framework, because from a valuation perspective, it felt like we were in very elevated territory. From a sentiment perspective, it felt like there was a lot of froth in the markets. And from a near-term earnings outlook, as I said, we were worried that it was actually beginning to moderate. So when we put it all together, the framework was recommending an equity allocation of 20% in the balanced advantage fund. Now, the same framework in early March of this year went up to 60%. Why is that? As I said, mainly because interest rates in this framework, when we think about equity valuations, we also consider fixed income interest rates. So the fall in fixed income yields definitely served as a positive for equity markets. So that from a valuation perspective, now it felt much better than where it was last year. And sentiment also had moderated significantly in the last 6 months prior to March. And so the equity recommended allocation moved up from 20% to 60%. So in our balanced advantage fund, we hence sort of like started increasing our equity allocation, where at the bottom, from a practical perspective, we were probably at 28% or so. That has moved up to more than 60%. A lot of it was actual deployment of capital into equities. So that was clearly a very conscious move. And then on top of that, to the extent the markets rebounded, there was also a mark-to-market impact, which led to the equity weight further going up, essentially.
Okay. I'm going to try and construct this question because there are several thoughts that are running in my head based on what we've also spoken, Dinesh. But a couple of things. The evidence of a drawdown in the markets getting rebounded very, very quickly. So the availability of a gap to deploy, especially if you're in a contra sort of a strategy, is limited. So that's one. Two, with the dollar doing what it's doing and heading lower, an anticipation that global flows into emerging markets and into India might look more attractive going forward, and you have more buyers for the same commodity that we are buying, which is equity, would result in a further shortening of that gap, one would assume. And three, the earnings, while there is an improvement, maybe not to the extent that you can feel comfortable at buying at possibly rich valuations. Do you anticipate, with all of these things, do you agree, first of all, with what I've said? And do you anticipate that, therefore, moderate return expectations are likely in the current financial year and heading into next year?
Yeah, I completely agree with that. When you look at India, right, in some sense, from a macro perspective, things have never been better. When you look at corporate balance sheets, when you look at the way growth is sort of getting constructed, there aren't, signs of over allocation into certain sectors or something where you're really worried about India from a macroeconomic perspective. So those things are firmly in place, and there are no real concerns there. The concern really is in terms of how fast can the economy grow. Right now, it is hovering in the 6.5% plus or minus kind of range from a real GDP growth perspective. The earlier expectations were that we will inch closer to 8%. That is not visible, at least for the time being. And so that is the real sort of crux of the matter, that the economy is not going to grow at a very, very robust pace. And to the extent corporate sector is a part of the economy, so corporate earnings also are not expected to grow at a very robust pace. So now, when you sort of think about flows, as you said, yes, flows are likely to be quite supportive. I don't think flows slowing down is going to be a real issue for the markets. valuations are on the elevated side, so that's a headwind. And earnings growth, while it is improving, it is not going to improve dramatically. So when you put it all together, the end result is one of moderate return expectations, or at least that is the way we are also thinking about markets, where it's not going to be something really bad, but is it going to be a repeat of what we saw in the 2020 to 24 kind of period? In our opinion, unlikely.
Absolutely. Dinesh, couldn't have said it better. Thanks so much for joining me today. Absolute pleasure having you on the program.
Great. Thank you so much.